It will definitely increase safety and soundness, and it will definitely reduce, you know, the numbers of problems that arise from the system. But what are the unintended consequences? Well, the first unintended consequence is that this costs an awful lot of money. You know, if the banks are going to have these reporting functions, if they lose control over pricing, if they lose control over the timing of adjusting pricing, then somehow they've got to get that money back from someone, somewhere, and the person they're going to get it back from is the consumer. If you've noticed in your mail, you probably have gotten a letter from every one of your credit card companies telling you that the max rate on that credit card is now 30%. And that so infuriated Congress that they said that this credit card bill, instead of going into effect in the middle of next year, will go into effect December 1st. All right, the second thing that they've done so far, even without the bill being passed, is this overdraft issue, which is great, you would think, from the consumer standpoint. You can't increase the overdraft fees. You can't charge more than 4 overdraft fees a year. The problem is that if you change the overdraft function, 30% of the accounts, and I've checked this with numerous bank consultants and banks, so even though I can't give you the exact numbers, 30% of the people who have accounts in banks in the United States will be unprofitable to the bank. And what's the bank going to do? It's going to kick them out. It's going to start firing customers. It's what they did in the 1990s. In the 1990s, there's a bank consultant, a guy named Jim McCormick, who runs First Manhattan, which I think is the best bank consulting firm in the country. Excuse me. What McCormick did was he said, we got to get rid of this 80-20 rule. 80% of your customers are creating 20% of your profits. What we've got to do is make those customers profitable. And the way we're going to make those customers profitable is we're going to jump the costs of banking for those individuals. So the net effect was hundreds of thousands of people left the banking industry. You remember the stuff in the paper, if you want to see a teller at First Chicago, you got to pay $2. If you visit a Bank of America branch more than 3 times in a month, you get a $1 statement charge. So in essence, we're going to go back to that. We're going to go back to a system where the banks are jumping the prices of consumer finance, and we're going to force, I'm going to tell you, millions of people out of the banking system. That's an unintended consequence that they're not thinking about. Another unintended consequence is they can't lend money. You can't raise capital and raise liquidity and at the same time make loans. It just doesn't work. There isn't enough money sitting on that balance sheet to allow you to do that. So the net effect is what you're doing in this situation is you're basically creating a situation where the banks can't lend the money. The third thing that you're doing, which is an unintended consequence, is talk too long. All right. One final point, all right? And that final point is that the last unintended consequence is that you're shrinking the American financial system as a percentage of the world financial system. You're weakening our financial power because in 1945, 100% of the currency in the world was the dollar, right? Today, there are more euros outstanding than dollars. There are more yen outstanding than there are dollars. Dollars are only 19% of the world's currency. If we shrink our banking system, which is what we want to do, we get back to where we were in 1990, when the biggest bank in the United States was Citicorp, and that was the 22nd largest bank in the world. And President Bush at the time and Treasury Secretary Brady at the time basically indicated fairly clearly that this was inhibiting the growth of American corporations around the world. So net of what I'm saying to you is that I think the Congress is trying to solve the wrong problem in the wrong way. It's moving the banking system in the wrong direction, and every one of us are going to see negative impacts on our cost of doing banking and the ability to grow our businesses as a result of what's being done. And I apologize, I'm just talking too much. Okay, thank you.